Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Liz Young. She's Chief Investment Strategist, Head of Investment Strategy at SoFi. We're going to discuss seasonal patterns in the market, not necessarily look at the monthly or quarterly trends. Liz, it's great to have you with us. Welcome to Trade Talks.
Great to be here. Thank you.
Let's talk about the inflation data that we got this morning before we get into seasonal trends. It seems to be that inflation is going the way that the Fed wants it to go. How do you think that's going to potentially impact their strategy?
Yeah, it's certainly moving in the right direction, right? And we got down to a level that I think many of us have been waiting for and hoping for at that 3% level. And looking at what the Fed might do in a couple weeks, the market still largely expects a hike, a 90% chance of a hike. I'm not sold that they have to hike anymore. And in fact, even before this inflation print, I was feeling like they might be done with this hiking cycle. They've continued to reiterate they didn't want to do the stop-start monetary policy of the 1970s. So I think that if they can get away with being done and just kind of holding rates higher for longer to see if that continues to take care of the inflation equation, they would do that. Today's print was certainly a move in that direction.
But it's so interesting, the market continues to trade as if it's expecting cuts or a more dovish Fed, but they really haven't been telegraphing that.
Right. They've been saying exactly the opposite, right? And what we've seen is that financial conditions have loosened quite a bit over the last few months, which isn't really what the Fed intended to happen. And I think right now we're at this kind of precipice where if they cut too soon or signal too soon that they might stop or cut and move in the other direction, you see conditions ease even further, and then you have the risk of inflation picking back up. So I think they're trying very hard to make sure that that doesn't become a problem, because then we have inflation that's entrenched. Right now, like we said before, moving in the right direction. Also, I think people should remember the peak in inflation was June of last year. So now comparing the year-over-year numbers to June of last year, which was the highest reading we had in this cycle, the readings are going to look good. Moving forward, inflation started to fall after that, and it could get trickier to have big declines in the months ahead.
And we typically look at patterns from a monthly or quarterly lens, but you took a look at seasonal trades. And
Right.
Did you see any differences that stood out to you?
Well, monthly and quarterly and just the calendar in general. I mean, the market doesn't necessarily care so much about the calendar, and seasonality is something that I don't think means a lot in the short term. But over long-term periods, there are really discernible patterns. And what I wanted to see was, we've all heard the old adage, sell in May and walk away. Summer is a low season. In reality, risky assets tend to do pretty well in summer. But I think this year, because we had such a standout spring, I don't know that we're set up to have another standout summer, especially at these valuation levels. And the thing that's really important to look for in summer too is that there's sort of this time of rolling vacation, so volumes are down, right? Trading volumes get lighter throughout the summer, which can make for kind of complacency or just kind of a smooth ride through that season. Or, on the contrary, it can create bigger swings because there isn't as much volume moving around on a daily basis. So if there's a shock, if there's a big news event, that low volume can create a more exacerbated response.
How do these trends play into your investment thesis for the remainder of the year, or just at least through the summer?
Well, I do have my eye on fall, because if we're moving into now a time where the Fed is either done or maybe there's just one more hike, I doubt there would be two, then we're kind of starting a new piece of monetary policy. And as we get through the summer, rates being held high, you get into fall, and then we start a new earnings season. We're looking at the year ahead, and I don't know how much more stocks can withstand these high of rates. So I think fall is possibly ripe for a pullback. I do think that these valuations are extended given where yields are, given where we are in the cycle, and they at least deserve some sort of what I would call right sizing. That doesn't mean that we need to hit a new bottom anytime soon, but a right sizing just to get some of that excess out of the valuations.
It's challenging to put money to work if you haven't participated, let's say the Nasdaq 100, that
That's
35% move that we've seen in the first half of the year. It's going to, when we get into earnings season, they're really going to have to be able to justify these multiples and provide guidance that can shore up these prices. And it seems like such a bifurcated market in a way. There's the bull camp, there's the bear camp, and you're on one side or the other, but perhaps it's just not time to your point, call a bottom or put fresh money to work when you have to be able to justify these valuations.
Right. Well, so the bulls versus bears debate has gotten increasingly heated over the last few months. And interestingly, we've seen this big swing of mostly people being bearish, and now they've switched to bullish if you look at some of the surveys that are out there. And it was a very quick and large swing from bearish to bullish. So that's an interesting sort of shift in sentiment. A lot of times when you get an extreme swing like that, it tends to come back towards the middle a little bit because it usually overshoots. The thing about earnings season, regardless of whether you're bullish or bearish, is that this earnings season is still expected to be negative, depending on what source you're looking at. It's expected to be negative 6.8 to about 7.4% for the quarter. So the bar is still pretty low. So it doesn't take a lot for companies to still be okay or at least meet lowered expectations. But to your point, which is absolutely the important thing, is guidance. And when we've now started the second half of this year, you start bringing into the conversation 2024 earnings. And 2024 earnings are pretty optimistic. So CEOs are going to have to say things that justify that growth target and those optimistic targets for the following 12 months.
Yeah, well, you can't just have AI in your transcript 100 times. And
Correct.
Your stock to take off from there. All right, Liz, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.